Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, June the 6th. I want to take just a brief minute to discuss what markets did last week, with the S&P 500 finishing the week off 51 basis points, or down 0.51%. However, the mid caps and small caps were positive last week, kind of bucking a trend that we have seen in those, with the mid cap index being up 21 basis points, or 0.21%. And the small caps, as measured by the S&P 600, were the leader last week, up 70 basis points, or 0.7%. So as we talked about last week, and as we were heading into this week, we talked about the increase in volatility that we expect to see over the summer. And that has come to fruition. Even in an intraday basis, you're seeing very, very big swings in the market, starting down, closing higher, starting lower, much lower, not finishing as low. And so you're seeing the market have a lot of internal volatility. But what I wanted to point out this week is a couple of things. I want to talk about the valuation of the market itself. Are we at peak valuations, or does this market have room to grow high, or move higher? And then talk about the technical analysis that we're seeing. And we'll start there with a technical analysis. And as you know, at River Place, we talk about the money flows. We track money flows in the market, and that is, does the stock close above its arithmetic trading mean for the day? So if it opens at 100, dips to 90, but closes at $96 a share, that stock would still have what we would consider positive money flow, even on a down day. So if it's opens at 100, goes to 110, closes at 106, that stock would then continue to have positive money flow. So what we're seeing in the equity markets themselves is that the money flows are actually much stronger than the volatility would let you believe, and that we really believe that this is going to be technically a catalyst to keep us moving and moving up in the right direction throughout this summer, as long as the technicals hold up. The thing that drives the market ultimately is earnings, and more earnings. And it would be great if we got an interest rate cut from the Fed in there, as the ECB did cut 25 basis points today. But if we could keep the margins the way that they are, that's what's going to propel the market where it is. So you're seeing signs of a slowing economy, and what the market is seeing is still some very, if you want to find positive market indicators, you can, or economic indicators, you can. There's plenty of positive out there. The service ISM services and the manufacturing both came back this week positive, and so above the recessionary threshold. And then I also want to talk about the valuations of the market. Oftentimes you'll hear the market stretch is at a high valuation. You know, this is 99 2000, we're on the precipice of another bubble. But I wanted to break down where we sit. And right around these levels, the S&P 500 is trading at about 21 times forward earnings. So a little bit on the pricey end. I mean, we've been stretched to 22 times before in a healthy market. But if you strip out the Magnificent Seven, which they're trading at about a 30 times multiple, and those are the ones that are the largest growth companies in the S&P 500 that take up the most market cap weight in the index, in the S&P 500, those are trading at 30 times PE. Historically, it's not that expensive. I know it sounds like a lot, but it's not historically. You strip out those seven names, the rest of the S&P 493 is actually trading at 18 times earnings. If you get down into small and mid caps, you're at much lower PE ratios, and that's why you started to see a little bit of a catch up in these small and mid caps last week, as interest rates have come down from 470 all the way down to 430 on the 10-year where we speak today. And so that's why you're seeing there's opportunity underneath the surface. When you look back, 18 times earnings is historically the average that the market has traded at. And in good economic times, you can run it all the way up to 21, 22% times forward earnings on a technical basis. So as long as the fundamentals remain the same and earnings can remain where they are, expect to see this market move higher. Now, expect it to not be a straight line higher. Expect it to be a very bumpy ride. But if you have questions about how to navigate the bumpy ride through this summer, call us. We'd love to talk to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.